The death benefit of a whole life insurance policy is a tax-free windfall to your designated beneficiaries. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installment in our EncycloMedia series, we are going to discuss death benefit. Now, the death benefit of, and here we will be talking about a whole life policy, and particularly for the purposes of implementing infinite banking. But the death benefit may be referred to as the face amount. It is the protection amount of the policy. It is the death benefit, meaning that at the maturation of that policy, whether that is upon your demise or whether it is upon you reaching age, say it's a 121 policy, you reach 121, that policy matures. If you're still living, you're just going to get that death benefit amount at that time. Otherwise, if you die prior to that maturation date, then your designated beneficiaries will receive the death benefit, the face amount. The coverage would be another term that's used when referring to death benefit amount. So death benefit, face amount, coverage, protection. I think this is a good time for me to reiterate that the death benefit will be paid tax-free to your designated beneficiaries. You may designate contingent beneficiaries that may be of importance to note and to update accordingly throughout life. You may want to update who beneficiaries are on policies, especially as you build a system of policies. If you are becoming your own banker, you're acquiring and building a system of properly structured whole life policies with mutual companies that pay dividends. You may want to change who the beneficiaries are on some, add some contingent beneficiaries for this death benefit that will be paid to those beneficiaries. Now, the death benefit will be paid, again, tax-free, and it will be at the time of death. It will be minus any outstanding loan. So whatever that face value amount is, whatever that death benefit amount is, if there is an outstanding loan, that would simply be minused from whatever the protection, the coverage amount is, and then the rest, of course, would be paid because, and again, let me explain this, that would be because you as an owner, let's say if you accessed capital from your policy via a policy loan and you were using that for living expenses, investments, whatever it is that you were doing, you'd already accessed that portion of the death benefit. So that would just simply be deducted from the death benefit amount that would be paid to your beneficiaries. Now, the death benefit amount in a policy that's been structured for IBC purposes is not necessarily going to have a level benefit. That benefit amount can increase. Some reasons for that death benefit amount increasing could be you paid additional PUA premiums because that buys more death benefit. It could be, of course, because of dividends. While dividends are not guaranteed, the policies that we would be wanting to own would be with companies that have paid dividends for over 100 consecutive years at a minimum. So the dividends could be buying more paid up additional insurance, of course. So just because you have a whole life policy, that does not necessarily mean that the death benefit will stay level, which is great. We want to see that number go up because it inherently means that the cash value of the policy is going to go up as well. I would encourage you to be really familiar with your particular contract or contracts. There may be some limits on what the death benefit may grow to, even though I've just said that the death benefit amount may not stay level. Dividends, extra paid up additional premiums being paid, things of that nature increase the death benefit. But again, be familiar with your particular contract because there may be a stipulation that, well, it won't grow over this amount of money, or that will not be paid in excess of $10 million or whatever that number happens to be. There may be a stipulation there. Be familiar with that. Let me share a quote from R. Nelson Nash that impacts this particular view on death benefit. He would say, and I do believe that the properly structured policy is the ideal asset, but he would say that our need of finance is much greater than our need of protection. So it's my belief that everyone should be insured to the dollar amount that they possibly can be as soon as possible, and it be done with properly structured whole life policies with mutual companies that pay dividends so that we do have that base covered for sure, the protection side. But of course, when those policies are built that way, that is the entity, the ideal entity that we can use to become our own banker at the same time. So I hope that this has been helpful. Make sure to check out more from our EncycloMedia series for detailed looks at the particular verbiage and the definitions and helpful, actionable information on vetting this idea of becoming your own banker. I do have a free introductory presentation on my website, my calendar link, and more information that I hope will be helpful. This has been a great pleasure for me. I hope you have a great day. You can find me at DurhamTalents.com. Take care.